Good afternoon, everyone. My name is Oliver Blokland. I'm a Senior Conference Producer at Global Investor Group, and it's my pleasure to welcome you all to the final session of this ISF and ISLA Security Finance webinar series. The sessions have all been extremely well attended, but if you did miss any of the webinars, they have been uploaded for you to view in your own time. Today's session is entitled Perspectives and Conclusions from ISLA. On behalf of myself, ISF, and ISLA, it's great to see so many have joined us for this final session. I'd like to take this moment to say a special thanks to Andrew Dyson and Sajal Amin and the whole ISLA team for all their hard work behind the scenes. I'd also like to thank our 17 sponsors who have made this event possible and for their continued support. I'd just like to remind everyone their information is on the microsite where you registered, and they are sharing genuine thought leadership and white paper materials. This 1-hour web conference will be a discussion between Andy Dyson and Roy Zimmerhansl. If you wish to ask a question, you can do so by clicking the Q&A button. Nice and short, I'd like to now take this opportunity to pass it on to Andy and Roy, who will be sharing this discussion today. This session is being recorded. It is now my great pleasure to introduce Andy Dyson and Roy Zimmerhansl.
Hi, Oliver. Thank you very much for that introduction. And let me add my thanks to Global Investor, ISF, and ISLA, as well as the sponsors for the great event. I'm Roy Zimmerhansl. I'm the practice lead at PurePoint Financial. The good news is I have the easy job where I interview an eloquent and well-informed guest. And that's actually been helped by a number of the moderators who've kindly sent through questions for me to grill Andy with, as well as a special shout out to my colleague John Arneson, who helped prep me for this. So thanks very much. Look, my final observation before I hand over to Andy is that it's just been great to see so many of the speakers that have grown beards over the lockdown, and that there's so much white hair in those beards. So with no further words from me, if I can introduce Andy Dyson, Chief Executive of ISLA. So Andy, welcome. Listen, Andy, it's been a great event. Why don't you share your observations with us and any sort of opening thoughts?
Sure. Good afternoon, everyone, and many thanks for that kind introduction. I'm sort of compelled to say that obviously Roy felt his job was going to be easy because you'd found somebody eloquent and articulate to talk to, but unfortunately he wasn't available, so you got me instead. I just felt I wanted to say that. But also the point about the beards and the hair. Listen, I think Mark Faulkner must have the prize for the most bonkers-looking hair on any of the sessions we've seen. And for any of you who saw me on any of the earlier sessions, the good news is I've had my hair cut. So I'm not sure what that means, but we're now in a slightly different place. Listen, before Roy, we've done a couple of these in the past, and I'm hoping that we keep it fairly conversational. But I wanted to give the sense to the group and the audience as to what we've seen and what that means for us as an industry over the next few minutes, and what are the pointers as we look further out. I too just wanted to start though by thanking the teams at ISLA and ISF, plus all of our sponsors, for making this event happen. It was a bit of a bold step, I think, from our perspective to sit down with ISF and think about doing something quite different. We've had really good and diverse attendance over the 2 weeks. I think any of you who've seen any of the sessions will confirm that we've had a very full and robust agenda, and I think that the final thing I'd say is that looking back, we've had some really interesting sort of highlights from a technical input perspective, which I think, Roy, we should spend a bit of time on. But the final thing I'd say before I talk about some of the more serious things that we've seen is that I think going right back to that very first panel, the industry leaders, Matt Burnett certainly wins the prize and continues to win the prize for the most creative use of his backdrop during any session we've seen. And I think only recently did he get run a very close second by Roelof van der Stroek on my panel on sustainability earlier in the week. But apart from that, I think that we've seen a really great willingness for people to embrace the new way of looking at these events, join in, great questions. And if we're all honest, we know as an industry, we're quite good at not taking ourselves too seriously at times. So I think I'd really, thank all of the participants for that. So what have I seen over the sessions, Roy, before we get into the meat of it? We heard a number of things, and we saw some themes which I think we saw repeated over a number of the sessions. We're at the end, if by some people's reckoning, or maybe at the beginning of living in a very different world. We've just come through the beginning of a global pandemic. We're not sure what's going to happen over the next sort of few months, but certainly the world is very different. Here am I sitting in my dining room talking to you. Roy looks like he's sitting in a cupboard, I think. But anyway, we'll move on from that one. But what did the industry do? We were tested to the extremes. During that period of March, we saw intense volatility. I think that the COVID panel itself talked about 5 days of unprecedented market movements of more than 5%. On one day, equity markets fell by 12%. These are not insignificant things to be managing, particularly when you're at home, sitting in your kitchen. I think the other thing I saw in terms of those themes is, although this crisis was not born out of financial services, it quickly enveloped our world. But I also feel that we as a group, as an industry, we did well. And one of the reasons we did well is banks are much better positioned and capitalized to withstand these shocks than perhaps we saw in 07 and 08. And although we don't often give regulators enough credit, I think, to be fair, the work they've done to improve the capital stability of the banking sector has proven to be the right thing, because banks have been very robust during this current crisis. I would just highlight the fact that we haven't seen any suggestion of a major counterparty default as we saw in 07, 08. And I think that's been a material difference in this crisis. As I said, managing volatility was the hardest component of the crisis. Quite a lot of debate in those early sessions about whether risk is priced correctly, which we'll come back to. The other couple of themes that came through that I'd like to talk a bit about as we go through, Roy, is standardization came through as a common theme, whether it's through documentation, development of so-called common domain models for trading and post-trade lifecycle events. But it's there. As an industry, we've got to think about how we capitalize on, what was said right throughout all of the sessions. And the final one, Steve Kiley this morning mentioned that we managed to get into 30 minutes into a session without mentioning ESG. Then he answered the question I sent in on ESG. But this is a topic, or a range of topics, which is frankly at the center of the regulatory agenda and will be so. I think we heard from Tijana from Fleischmann talking a little bit about the European Commission's perspectives on ESG and how they'll be using the ESG platform as part of their response to COVID. So I think it is at the center of everything that we do. And we ignore ESG at our peril. I don't think we are ignoring it. You've seen the work we've done through the ISLA Council. So those are my sort of initial thoughts and reactions as to what I saw, where I think we are. But Roy, I think you had some other points you wanted to dive into, but that was my sense is we're doing okay. We live in a different world, but you know what? Don Duramo summed it up quite nicely. This morning. We are a resilient bunch, and we sort of know how to deal with change. And we just had a whole bunch of it thrown at us, and we're dealing with it.
Yeah, and I think you've kind of hit on the key point here. So I think whether you look at the questions about intraday volatility and what that does to margins, or you look at what the volumes were in terms of collateralization within our business, but also within derivatives, both cleared and uncleared, I think we've seen a huge wave of activity, Andy. So that's why I'm curious about exploring this idea about whether people are being properly compensated, whether the fee levels are right for the element of risk. What do you think about that?
That's a great question, Roy. And I think just going back to something that Matt Burnett said, that I thought was interesting. He felt that he could see a moment in March when he could see that, in his view, he was about to get compensated in terms of pricing for the risk that he assumes when he lends securities. But I think he made the point, I thought an interesting point is, he felt that the world was saved a bit too quickly by the role of central banks coming in and dampening down some of that trading volatility, and we sort of went back to a more normalized world. Matt has talked about this before, and I think it's a valid point to think about. Is do markets broadly correctly price in risk? And if you look at even just CDS spreads between govies and corporates, they've gone back to quite low levels again after periods 0708 when there was some quite extreme variations. And I think that the simple fact is I personally feel that markets perhaps don't quite rightly price in risk to reflect some of the risk you run. But having said that, when agents lend securities, I think we would all regard that as a relatively low risk activity. It's collateralized with daily mark to market, with often a tri-party agent looking after your interests in terms of marshalling and understanding your collateral. So I think it has elements of being a very low risk business, and those of us that have sold these products in the past would always say it's a low risk activity. So I think it's quite an interesting debate to take forward, and I think that I think what Matt was also talking about is the hedge fund community have a more sort of dynamic pricing model with their PBs, and I think Matt was looking more to see that. But I think as Ben Chalice said, I think that's all there. It's just a question of people taking up that opportunity from a product. So I think there is work to do there, and I think my view has always been let the market decide on that. And I think we see where that goes. But I understand what Matt's saying.
Yeah, so I think there was an interesting point yesterday. I think it might have been James Templeman who raised the point about the intraday volatility meant that, the 5% collateral margin was okay sometimes and not okay other times. So do you kind of see all of this blending into a revisit to the risk profile of the business?
I'd like to say yes, because I think James is quite right that, when you've got a sort of a static business, and most securities lending positions tend to be revalued at the end of a given day or trading period, and then we look at market movements and then they get revalued again. Most people aren't living in a central clearing world where central clearers have the opportunity for intraday margin calls, which I think we saw during the height of sort of the March volatility. I think the point there, Roy, is that how much appetite is there for that type of quite sensitive calibration of risk tolerances when you've got to put a lot of money into the clear. We all know the clearer you get to real time anything, the more expensive it is. Okay, from a systems perspective, many people perhaps looking at this call will be still trading with trading systems that are probably a bit older than some of the people that are sitting on the end of the desk. And therefore, it's quite hard to see how you align that when it might be easier just to say, well, do you know what, if 5 doesn't work, I'll do 10. Because that might get you where you need to get to without having to think about how do you actually manage intraday pricing and collateral movements. If you're not trading through central clearing, the easy answer might just be to go from 5 to 10 to 15, whatever the buffer is, because that's a fairly blunt tool, but it might cover you. Do you see what I mean?
Yeah, I mean, I think we have a range of topics, so we'll move on to this. My only observation in this issue is that ultimately, for me, your starting point is who's the counterparty you're dealing with, and the one thing that stands out to me about the massive market ructions we've seen over the past few months is that counterparty risk has never really put its head above the parapet, and the regulatory infrastructure we have now and the capital requirements and the increase in more real-time activity across other areas has meant that maybe the counterparty risk issue is not so big. And as long as your counterparty is still in business, then backed up by the collateral and indemnifications and everything else, this is a pretty safe business.
And the thing is, right, and I agree that, we'll move on, but securities lending is a bit like, our friends in the repo world, where it's always a combination of balancing your counterparty risk with your collateral risk. And there's always that balance between lesser quality counterparties and higher quality collateral, or vice versa. I think that we live in a world today where most people who borrow securities are prudentially regulated institutions who are bound by increasingly ferocious capital requirements, which means that their counterparty risk, if you're facing them, is probably at the lowest level it's ever been historically. And therefore, we could argue that that bit of the equation has almost gone away. Of course, it's never quite gone away, but I think it's at probably a lower level than we've ever seen it. So if you're thinking about risk, and there's 100 risk points, I think the counterparty risk element is probably now maybe 10 points of that, with 90 of it coming through collateral. And that probably means that we've got more capacity, therefore, to think about other forms of collateral, principally equities, with counterparties who are inherently stronger. That's the way I'd look at that in terms of how you take that debate forward.
Right. So thanks, Ed. I think it makes sense here to move on to the next topic. And
yeah,
for anyone that's wondering, these are the industrial size strength headphones that I have on for my podcasting. And in today's podcast, I actually talked about revenues. And so the key point, I think, Andy, that you started talking about was, what's the revenue for the risk that you're taking? And the reality is revenues are down. Yeah, revenues are down the first half of this year. Not that different from the first half of 2017. So it's not all, pandemic related. And look, ultimately, Europe has had a real string of bad revenue years. So talk to us about the revenue side of this.
Okay, so it was fascinating, because I was listening or watching the last session this morning, where I think Nancy from Equilin was talking a little bit about some of the numbers they've seen. And in that sort of perverse sort of way, although general revenues were down and we saw those numbers, if you're holding the right stocks, you made a lot of money in the last quarter. So if you were holding stocks that that were seen as interesting stocks to short from a COVID perspective, so airlines were a good example that she used, you potentially, there was a lot of revenue on the table there you could take. Clearly Wirecard was in that top 5 for other reasons, but so I think I just wonder, in the short term, there's been a lot of talk over time about the demise of so-called GC type business. And you and I, Roy, have talked about that for years and years and years, on and off. What we seem to be seeing at the moment is, almost by no one actually consciously doing this, but we've moved into a value-based lending proposition, i.e., if you've got hot stocks, you can lend them and you make a lot of money, but outside of that, there's less revenue opportunities. So I think that the value proposition rather than the volume proposition, which are two broad ways of thinking about the business, the value proposition seems to be where the money is being made at the moment, rather than perhaps in the GC world. What we don't know is how that's going to change over time. So I think I think that's been a feature of this year, which is, if you're holding one of the hot stocks, you're going to have made a lot of money. But if you're not, you won't. But having said that, we shouldn't forget also that lending of HQLA government bonds has spiked, did increase significantly around sort of mid-March. I think once again, we saw in the earlier session from Equilend the huge spike in the demand to borrow US treasuries as the market became short of the treasuries, and there was huge demand to borrow them. So I think that the opportunities are there. Again, they're perhaps less obvious, and you have to work harder, either as a lender or with your agent, to realize those opportunities.
Well, that almost ties nicely into the next question. So this was not prepared earlier, but look, the reality is, there's a difference between revenues and profitability, right? And so, to me, the revenue side of the equation is always a challenge. So yeah, you can go into new markets, You can expand your collateral. Maybe you're looking at pledge rather than transfer of title. So there's things that you can do around the edge. But the thing where you have the most control over is cost. And really, isn't that more about sort of standardization? And you touched that on that earlier. And I guess there was quite a lot of discussion about common domain model and that this sort of debate between revenue generation and cost savings or efficiency. And how does that kind of tie into the overall picture and sort of going back into revenues as well?
Yeah, so you're right, Roy, that the top line revenue numbers are harder to predict, and to an extent are outside the control of individual businesses. Horrible phrase that I used, it was quoted this morning, I'm going to use it again, is that nobody lent a security people didn't want to borrow, and therefore this tends to be a borrower-led market, always has been. But what I think what that means though is both for borrowers and to a large extent lenders is what are the mechanisms you do control, and cost is one of them. Now we've had this issue for some time around so-called standardization, and it's worth just pausing to think about what that means and where that debate logically takes you. So the first thing is, look, SFTR in itself has been a huge wake-up call for the industry in terms of thinking about how you define in a common way certain things that we all do every day, whether it's identifying a security, whether it's identifying a life cycle event, a corporate action, or whatever. And SFTR has forced us to look at some of those issues that we've ignored for some time. Now, when you look at SFTR, we're now beginning to look at a standardized world. And then you then think, well, what can you do with that standardized world? And where can you take it? And one of the things that we've seen for some time is that there's a commonality around sort of data and description of life cycle events and the description of trading events, which transcends individual firms and vendors. So we all should be calling a return, and that might be as simple as, do I call it a return, or do you call it a cancel and rebook, or is it a partial? The difference between those two can actually mean that the thing will not match in a matching system or another platform. So by just beginning to address those issues, you get to a point where, as people look at systems and efficiencies, the first thing is, if you've got those commonality of terms and understanding of how securities move around the system, you naturally then begin to reduce things like fails and trades that don't match, and that has to be beneficial for the general cost ethos within firms. Now, but the other benefit that comes with that is when you start, if you like, mutualizing that common data level across all firms, then I believe that naturally allows firms to compete in a different way. And what I mean by that is, in the past, we've seen firms compete, whether they're vendors or market participants. They can compete on the fact that they've got a better ability at untangling the spaghetti and putting it together in a way that sort of makes sense. What we're saying is that firms should not be competing on that basis. They should be competing off a level playing field of a data commonality that then allows them to develop truly different products and services. And that's where markets need to be competing, and vendors need to competing, not on their ability to unravel the spaghetti, but actually their ability to provide incremental products and services that add value to people's daily lives and increase bottom line. So I think that standardization debate that started within SFTR has now moved into the work you've seen that we're doing around the common domain model, will provide that mutualized point within ISLA to allow people to then start developing new and creative products and services that answer all those questions about efficiencies. So does that make sense, Roy? I think what we're saying is we've got to think about the market in a different way now.
Yeah, so it does. But look, we're getting a bunch of really good questions in from the audience. And one of the things that came in was a question about this standardization. And let me just sort of put my own thoughts on top of it, because I think this is what they're getting to. Look, standardization and common domain model requires change, it requires investment, it requires time. So does standardization end up having an impact that there'll be fewer market participants, which I think is a great question. There's another benchmark hurdle that you have to be able to meet.
Okay, so look, I think up until now, I might actually take a contrary view on that, in that one of the big barriers to entry into our market has been some of the systems infrastructures you've got to punch your way through to become a successful provider of services, or services on both sides of the market, or as a vendor. If you as a vendor know that the service you're about to develop sits in the middle of a world that's completely interoperable with the market. So if you're broadcasting out a service or a product that is in line with those industry norms, actually, I think it could create more market participants, because people will see the opportunity to create an innovative product, but realize they don't have to wade through the morass of the pretty much uncoordinated way our market works up until now. So I actually think that if you are a provider that relies on those high barriers to entry for your current survival, that means you might have to change your thinking. But actually, if you're a provider sitting outside of our world and that natural barrier goes away and it's all about the quality of the products you're delivering, I actually think you could see more market providers come, more people come into the market, not less.
Okay, well, it's difficult for me to argue things that that I don't believe. Look, the reality is, I think that, as we debated at the post trade conference, I don't think that we're oversupplied in securities lending. I think that our cost and operating infrastructure is too expensive to put through marginal cost transactions. So I believe in that. But I think there's a valid concern that there is a cost element to get into the business, which has just gone up because of SFTR, which will also go up because of common domain model and standardization, because you don't. Okay.
No, I don't agree. So look, SFTR, of course, it is a cost of compliance. There's no doubt that if you are providing services that trigger a reporting obligation, there's a cost there, and we can't get around that. However, if you are talking about the provision of new services to the securities lending market, a good example might be that if you're a new provider and you know that you potentially have to link to 5 existing providers to fulfill the service requirement of your product, it might well be that you've got to develop 5 things to communicate with those 5 different businesses, right? And they could all be quite different because of the nature of the way those individual firms either face off to you or employ their technology or their infrastructures. If we're saying that actually you don't need 5 anymore, all you've got to do is comply with that standard, the CDM standard, then that barrier to entry has gone from 5 pieces of work to 1. So I would argue that from a sort of architectural structural perspective, that, and I'll come back to the cost in a moment, but that open source availability of something like the common domain model would actually reduce overall costs in the long run and reduce barriers to entry. Now, on the point about the fact that it costs quite a bit of money to develop a common domain model, and trust me, it does, having seen some of the bills float past my desk recently. But the key thing is they're floating past my desk because the way that you get the pricing point down to release the industry to do what it does best, which is be creative around the development of product, is to mutualize the cost of the infrastructure, which is the CDM, in somewhere like us. So therefore, if we if we deploy effectively our members' money on developing these types of things, then everybody essentially benefits at a relatively small incremental cost. That's sort of the model that ISLA have employed as they've gone through this work. And if any of you familiar with anything that we do at ISLA will know that's the model we've employed with our netting opinions, where we go and buy netting opinions effectively in bulk, and then we sell them back to individual member firms at a lower pricing point. And I do believe that one of the things that an association has to do, and I'm hearing it from everything I heard these past 10 days, is the mutualization of those issues is a very efficient way of pushing the market forward.
Yeah, so look, I think you sold me on that, Andy. Well done. The reality, though, isn't your challenge really the adoption issue? Because I think in the session where this was discussed, I thought that cartoon was fantastic, where you went from 14 different standards to a common domain model solution and
Got
resulting
15.
in 15.
Yeah, so I think that and you're absolutely right, and we've been looking at the idea of adoption and the challenges. And if I was to say to the market, we're going to take everything you do today, and then tomorrow, that could be a year's time, but tomorrow, we're all going to change it to this. They're all going to go, that's not happening. We don't have the time, the budget, the energy. We've just done SFTR. We've got to do CSDR, so it's never going to happen. So where we are on this in our current thinking is it's almost breaking it up into modular or bite-sized chunks. So if we can do something that uses the leverage of the CDM, but gives people the benefits, over time, and then you build up those incremental pieces, so that over, it takes a few years, but over a 3 to 5 year period, you suddenly transform the industry in small incremental steps that are digestible. That I think that's the way to go. So what we're doing at the moment is, and it's reasonably well publicized, but we're developing a proof of concept with a CDM partner, to actually prove the business case to not only our board but also our broader membership, to show that there is strong validity in doing this. But Roy, it has to be small, incremental, meaningful steps. The big bang approach here doesn't work, because let's not forget there's no regulatory imperative like SFTR telling you you've got to do it by this date. And therefore what we've got to do is work with member firms in the industry to say, well, if we take that element of whatever you're doing today and we bring it into this new world, that would make sense for all of us. And there's some obvious candidates for this, things like how you treat allocations in block trades. That's a very good example of it's just a bit of a mess everywhere. And I'm going to mention it, agent lender disclosure, my favorite topic. We all know that's just quite problematic. It's crying out for a bit more of this type of approach.
Right. And so I'll save everyone the full story, but this kind of reminds me of my time in Canada when we went from physically certificated settlements to book entry. It was a nightmare and really expensive for 5 years. And then at the end of that, everyone said we couldn't be processing today's volumes at the unit cost that we've got now without having gone through this period of adjustment. And I think that time period sort of accelerates given technology today. So thanks for that. You hit on a great timely topic of SFTR. We're a few days in. So what are you hearing, and what do you think?
Okay, so look, I think I said in a blog piece last week that I sort of hold my hands up to the entire industry, including the work we did at ISLA, and I think the industry's done a great job in bringing us to the point where we go live this week. And that's not been without its challenges. It's not been without its difficulties. And I think also we should recognise that our friends in the regulatory world have played a prominent role in helping us get to where we got to. I think in terms of what we're hearing, very early days. I think we were talking about it this morning within the group. I think right now it's primarily new trades going into the process, and therefore volumes are quite low, and therefore I think the experience is not bad. Obviously, as things ramp up and life cycle events start coming in and more volume goes through, then I think that we'll begin to see a little bit more about how robust the process that people have put in place have seen. But so far so good. I mean, but it is early days, and I think I think we would be quite keen to get some feedback over time from the trade repositories in terms of what they're seeing. Their initial view anecdotally has been it's been okay, but I think it's been okay in the context of quite good matching rates, but for a small number of trades. So I think we got a way to go, but you know what? I think we're starting pretty well.
So one of the things that someone actually raised to me, which I hadn't really thought about, is the thing about SFTR is that the regulation actually reaches out to the beneficial owner. Irrespective of whether they're the ones doing the reporting or not, it is their obligation for their end of the trade. So whether they like it or not, they're more directly engaged in the business than they ever have been. Do you see that impacting their involvement with ISLA, either as members or working group participants, or is it just going to be BAU?
Um, so look, institutional investors have always sort of, in this sense, fallen into two broad categories, and there tends to be quite a small community of quite large institutional investors who have a significant scale around their programs, either directly or through their agents, that this is a material issue to them, and therefore they have been quite involved in working groups, steering the direction of travel. But the vast majority of institutional investors or beneficial owners, sit within programs run by agents. And if I'm honest, I think they quite rightly have looked in the direction of their agents and said, so even though this is our obligation, how are you going to help us fulfill our obligation? So I think there is a way to go on this, but generally we've seen that type of approach. To answer your point though about engagement, that's quite fascinating, because I think that whilst we necessarily haven't seen a sea change in engagement at ISLA around SFTR, because I think the people we thought would engage have engaged, but most of them have left it to their providers to figure out the flows and the reporting. And in some cases, the cost of that reporting has probably raised some important questions about the profitability of individual programs, because I think we said right at the beginning, there is a cost around the compliance of SFTR that has to be borne somewhere. The big change actually, Roy, is happening is more to do with the debate around sustainability and ESG, where I think we are seeing, and Roelof was on the panel that I chaired earlier in the week, we are seeing a very different sentiment or tone from the institutional investor community that we haven't seen before. So I think actually that engagement story is not changing because of SFTR, it's changing because of ESG.
Yeah, and look, I think it's a really fascinating topic. I mean, we certainly are doing more work on ESG than any other individual topic with clients, but it's an interesting period we're in right now, because you and I have talked about this. This is where Europe is actually leading the world from an investment perspective here. We saw something from the Department of Labor in the US questioning whether ESG should be part of investment decisions or not. So, and even in the FT today, I just briefly scanned it. They were wondering in one of their articles whether this is all kind of overblown and overdone. I can tell you from beneficial owners that I speak with, this is here to stay, as you said.
Yeah, listen, I think it came through in the session that we had in the week on this, that the first thing is at the highest level, Europe sees global leadership of sustainable finance, or ESG, as something where it can actually lead globally, because for whatever reason, the United States has walked off the stage on this one, certainly at that higher political level. So therefore, working with, I think China, that acts between China and Europe, there's this great potential momentum around sustainability, the ESG agenda. We know that Europe has some very ambitious plans around ESG, and I think we heard in the session that quite a lot of those plans need to be funded effectively through changes of behaviour within private sector. There is no doubt sustainability is going to be at the heart of that policy development. And the bit I think that's changed, and the bit that I think is down to COVID, is that some of the things that clearly need to be addressed because of what the pandemic has brought to us all will actually come back through the green agenda or the sustainable finance agenda. So things about listen, anecdotal example, and I've used it before, but I'll use it again. State aid has been provided to Air France as part of the reaction to COVID, and the difficulties that Air France are in. But that's come with some green preconditions. So, for example, Air France have got to move away from domestic flights. They've got to rely more on the high-speed trains they have in France, and that sort of thing. So, I think when you see that, it's very, very important that we as an industry, think about how we respond to that. And Jack English was on the panel just before us this morning, and there was a question asked about, the role of short sellers and ESG, and Jack, quite rightly, in my view, because I support the view, is that short selling and the scrutiny of short sellers is a great governance. It's the G in governance that allows the market to scrutinize what firms like Wirecard are doing. So I think that in the round, what we've got is a number of things that we as an industry have been doing for many years, and some of them are now being wrapped into this ESG sort of wrapper or umbrella. And I think, that's important because it provides a level of clarity and certainty. But also we need to recognize that some of these issues that we've been dealing with for years, Roy, another good one is voting, and I think where we're coming from on this is we hear what institutional investors are saying. We heard it from Roloff on the panel earlier in the week. We have responded to that by creating the ISLA Council for Sustainable Finance. Radek Stek, who's the chair of that group, was also on the panel, a short presentation earlier in the week. And what that group is there to do is provide a forum for independent discussions around how you reconcile the world of securities lending with that of the ESG agenda. And some people would argue you can't reconcile them. Of course, I'm going to say you can. That's my sort of job to say that. But I do believe that. And I think it's incumbent on us to work on how you do that and provide those frameworks that regulators recognize, institutional investors recognize. And I'm very, very encouraged with the level of interest we've had in the council from the institutional investor community, Roy. So go back to your original question, that's where we're seeing engagement. We're seeing that engagement from those institutional investors who actually see there's some work to be done here to work with their boards and their investors to assure them and give them comfort that this thing called lending that everyone hears about every now and again in the press is actually compatible with an ESG strategy. And I think that aligned with the digital agenda, which is, if you like, figuring out how this market functions, the ESG agenda is the single biggest agenda we've got to get right as an industry.
Look, and Andy, just developing that though, so do you think that there's the potential to develop this further and actually get some of those borderline investors that haven't participated to join in?
I'd like to think so. And we saw obviously the high profile decision by a fund in Japan around about the turn of the year. That seems a long time ago now, to withdraw from lending. And I think, amongst other things, they cited governance issues as a concern. We have to listen to those concerns, and rather than just dismiss them and say, well, they would say that, blah, blah, blah. We can't do that. We have to listen to that concern and say, so why are they saying that? And what are they concerned about? And can we give them the comfort they're looking for? Sometimes we can't. But actually, I think we can. There's more we can do to give people comfort around things like governance and voting and short selling and all these things that sort of swirl around that side of the debate. I think as an association, and we've spent a lot of time in the last 5 years, amongst other things, figuring out SFTR. We've still got CSDR to do, and SFTR will come back again, I'm sure, in some shape or form. But you know what? We've also got to remember what we're here for. One of the reasons we're here as an association is to advocate for the development of markets. And that includes people who aren't lending, who might forget what might be going on in new markets. But actually, we've got a whole bunch of people in developed markets who aren't lending. And I think that the other big thing that's going to come out from Europe is the development of the Capital Markets Union. Now that's changing because the UK has decided to leave, obviously, and therefore Europe has got to figure out how it develops a broadly based capital market ecosystem that it moves away from the traditional bank financing models that have prevailed across most of Europe. Now, securities lending is an important part of that. It's not the only part, of course, but it's how you engender people to think about making their securities available for lending. And one of the things I'd actually say here, Roy, is, and this has come through in the consultation that closed yesterday from the Commission, is we mustn't think for 1 minute that ESG securities or sustainable finance securities are anything different from other securities. They're just securities, right? And therefore, I get quite worried when I hear that the Commission might be looking about separate infrastructures and exchanges to support ESG securities. That's really wrong. What we've got to do is make sure the existing infrastructures and processes work. And a good example of that is some of the things around the buy-in regimes around CSDR. They don't work for smaller, less liquid securities, which right now a lot of ESG funds are. So I think that there's quite a lot of, if you like, things going on that are beginning to converge in one place. And the Capital Markets Union, the agenda around ESG and the digital agenda are the three big things that I see driving our business over the coming weeks and months, if not years.
Right. Well, since you've talked about
Sorry.
CSDR, um, give us a view. I guess there's been a lot of feedback over the last few days. People have been talking about, whether the focus, being on buy-ins was really the right thing, or the penalties should really have grabbed more of our attention. People hoping that there might still be delays yet to come. I mean, where are we with all of that?
Yeah, penalties and buy-ins is an interesting debate because I think we lost the argument on penalties a long time ago, and I think we lost that argument because when I raised it a couple of times with both ESMA and the Commission, they pointed to what went on in the US Treasury market a few years ago, when there was a huge level of fails, and they brought in eye-watering fines. And surprise, surprise, it's the cleanest market in the world perhaps by now. So when you see that type of change of behavior because of fines, it's really hard to argue with that. Now, I think though with fines and fails, we've always taken a slightly different view at ISLA, and accepting that we don't like fines, we'd rather not have them, but I think they're going to be a feature. We decided to say, well, what are the things we're doing that's generating all these fails? And I think that you'll see from the best practice and the work we're doing in our best practice world that we've said to people, if you're failing because you can't get settlement instructions to match, you need to sort that out, because that's just not good enough. And if you're failing because you, the broker, are insufficient on the return leg because you booked the trade in before you knew if the security was coming in, again, you probably should get failed for doing that. You should get fined for doing that, because again, that's not acceptable. Now, people will say, well, that's all the way the business always run. Yeah, the world moves on. I'm sorry. And, and it's very hard to argue with a regulator that, we're failing for things because we can't match SSIs, or the broker is insufficient because his hedge fund client didn't give him back the securities on time. It's just not good enough. Now, there may be other structural reasons why things are failing, and we need to get to the bottom of that. But I think that we can't really have a proper discussion about fines when we're being fined for really things that we shouldn't be doing, if that makes sense. Many people on the call may not find that a very popular view, but I think that's my view. So therefore, I think the fines thing will naturally come to some sort of conclusion if we stop doing the things that keep getting us fined, if I'm honest. When we think about the buy-ins, yeah, there's some issues there. I think that the Commission have acknowledged that. The CMU high-level group who published a report, I think it was on the 10th of June, actually cited that they couldn't even come to a consensus on the buy-in rules amongst that group. That tells me that must have been quite a lively debate for a European Commission forum, right? And the fact they couldn't come up with a position would indicate that there's something wrong in those rules that need to be readdressed. And I do believe that we do need to work with regulators and policymakers to try and get some change around those buy-in provisions. And most importantly, the buy-in provisions as they currently stand will be a big disincentive to two things. The Capital Markets Union won't work if all the very securities that you're advocating should be issued and traded are the ones that nobody will lend because you get buy-in and then potentially cashed out. That's not going to work for market liquidity. And similarly, if you want to generate liquidity and get retail investors involved in ESG securities, you've got to get liquidity there, and you've got to remove that threat of buy-ins as they currently stand to entice lenders to lend. And let's be clear on buy-ins. I'm not saying we shouldn't have buy-ins. What we don't want is that mandatory track that when you get on it, you can't get off. Our market has worked successfully for many years with buy-ins. We have mini closeouts in our master agreements that govern these transactions, but they give the person who's been fouled into the option, but not the obligation to decide what to do. That's absolutely key. And although I don't want to get into the Brexit debate, Roy, one of the things that was very interesting that came out of the Treasury statement when they said a couple of weeks ago that they weren't going to adopt all of the provisions of the CSDR in the UK, I think it was very telling. They said they would instead rely on market-led initiatives to govern that side of the industry. So somebody was listening to the stuff that we've been banging on about for years, where we are a market that's well governed and well managed already, and therefore we don't need that additional oversight. We've already got it in there, and it's working really well, and it works to the benefit of the person being fouled into, not the detriment. Sorry, bit of a hobby horse, that one.
Do you know, I would love to carry on this particular conversation, because I think if ESG is one of the topics that we talk about, one of the other pieces of work that we spend most of our time dealing with is how do we make that baseline foundation of infrastructure more efficient so that some of the avoidable things can be avoided. And, you know, I think you're right to say, until you get that baseline strengthened and you no longer have any gaps in your own house, you can't really start challenging things that are imposed on you.
No, and I think, you know, listen, and I don't want to listen. Our guys in post trade, you know, from a member perspective, they do a fantastic job. Of course they do, and this is not a criticism of them in any shape or form. What it is, though, is, if you like, over time, there's been a bit of a malaise to fix these issues in firms, because quite rightly, if you're running a big business and somebody comes along and says, we're going to fix the SSI thing, but actually it's going to cost you X million bucks over 5 years, everyone's going to go, well, hang on a minute, that might affect my bonus. So we might not do that. We might prioritize that to not on my watch. So I think what that means, therefore, it's very hard to get spend in a world where we are still quite short-termism in our outlooks around the way we're all judged and performance and stuff like that. We don't want to go into how people get paid, but, you know, I think there just needs to be. So therefore, when you get these regulatory-driven initiatives, and I've been a huge critic of both SFTR and CSDR, but actually they do some good things as well. They make us change things that we've been ignoring for years. Is that such a bad thing?
Yep. And look, I would advocate that you can turn your operational infrastructure, if it's incredibly efficient, into a competitive advantage and help your bottom line.
Absolutely.
But again, subject for another day. Look, I introduced in the podcast this morning, I talked about, or in fact, not at the beginning, at
Apparently
the end.
Roy's got podcasts. Did you know, everyone? Sorry.
I haven't mentioned that, have I? But look, I said that SFTR was the one regulation that had a bigger impact on the business than anything else. And by the way, Andy, the podcast with you is still our highest listened to episode. So okay. What does that tell you? Okay. But look, I think while SFTR was big, Basel IV could be bigger.
Yeah, listen, there was a fascinating discussion on the reg panel. I think it was on the first or second day, and I think it was Mark Weston from UBS was talking a little bit about this, and you know, we suddenly realised that out there, and it's a bit like, you know, out there in the midst of these big sort of ships or icebergs, and every now and again one of them gets a bit too close to you. And what I think we see with, you know, the Basel regulatory framework is there's a couple of quite thorny issues there, which, unless we give them due attention, probably sort of now, is that that regime contemplates two things that are very problematic for our industry. The first one is mandatory minimum haircuts. Now, that's okay, and we've got some good arguments because many of our haircuts when compared to the mandatory levels are actually more conservative. However, we've got a bit of a problem in that our market tends to be one way, i.e. the borrowers give a haircut to the lenders to give them that additional comfort from a risk perspective as a comfort factor if the lender has to use the collateral to replicate the original on-loan position. The current structure within BAL doesn't contemplate a market that just has one-way haircuts. And I think that's a question of education. And I think we will get through that one because I think there is a wealth of previous work and academic work that confirms that, securities lending, for securities lending purposes, the haircuts, albeit above mandatory minimum levels, tend to be one way round. One of the challenges the industry will have will be financing trades. So, when you're doing a financing trade, actually the person on the lending side might actually end up giving the haircut to the borrower. This was actually something that came out in the very early days of the FSB work, FSB Workstream 5, 2015, I seem to remember. Unfortunately, at that time, it sort of went away. It's coming back, and there's some work to do there. The other one that's, I think Mark was talking about quite a bit, Mark Weston, was at the moment, prudentially regulated firms are allowed to, of course, rely on models to calculate risk and therefore RWA usage. And one of the components that is applying internally derived ratings for unrated counterparties. This applies to things like pension plans, certain UCITS structures, etc., etc. So anything that doesn't have a rating today would be assessed against an implied rating derived through the great work that credit departments would do, etc. The new Basel 4 regime doesn't allow you to do that. And therefore, if you had an unrated counterparty, it would have a very penal level of RWA treatment, which would mean that the businesses would have, I think, eye-wateringly more RWA consumption than they've had before. So my dog's just come in and decided to bark and gone off again. So I think there is a big piece of work to be done here across the industry to understand a little bit more about what that means. Looks like we got a bit longer because the BAL framework's been pushed out 12 months, but we shouldn't be complacent, because if borrowers have to put up higher RWAs against counterparties that are unrated than they do today, sort of asks a number of questions. Is that business sustainable, profitable? I don't know. The other thing is it might actually say, well, could you put some of this business through central clearing? So I think there's much to do in that little space to mobilize around BAL 4 and the BAL 4 framework. And you're right, Roy, it's another thing that's coming out of the mist where, interestingly enough, the rules aren't specifically written to either accommodate or not securities lending, but we could be on the back end of quite a negative unintended consequence. Does that make sense?
Yeah, I mean, I think, as you said, there are so many different aspects of it that all need to be addressed individually, but also holistically to make sure you're not giving in one and getting hit in the other.
And I think it's important for anyone on the call, member firms, to understand you've got to start thinking about this now, because if you're going to get things like BAL guidelines influenced or even changed, that's a long process.
Yeah. Look, Andy, we've got a few minutes left. There's one question that kind of follows on from that came in very early, and I think it's a great question. So we were talking about sort of the risk reward profile, and the question was, taking lower quality collateral from higher quality borrowers seems to make logical sense, but the market in March showed us that it's not actual tradable in a crisis. So aren't we really just betting on a borrower not defaulting? I think that's a great question that I think lots of people should be asking, even if we think that there's an answer. So how would you answer that one?
I think also it's a great question, and I would say that's not a bad way of describing it, in that if you're totally reliant on your counterparty to perform, and therefore you're less reliant on the collateral, you might be comfortable that that's less liquid collateral, particularly in a default, but that's probably not where you want to be. And I think it's just getting that balance right. And as we all know from 2007, 2008, where we all learned a lot about liquidity or the absence of liquidity. And I think that this current crisis, there was less of that because central banks stepped in quickly. So when money market funds, for example, were seeing quite high levels of withdrawal, they had nowhere to sell assets to. So fortunately, the Fed in North America turned up and bought them all. So it gave that outlet. And I think, so therefore, there is that risk. Of course, there's that liquidity risk, and liquidity is almost in my view, is one of the hardest things to price into a risk model because it's either there or it's not. It's quite binary, and it's not like counterparty risk where you've got a portfolio and you reckon 1 in 100 goes into default. It's not like that. Of course, it's either there or it's not, and therefore it's really, really hard. And I sympathise with that view that you might be just taking a view on counterparty risk. If you took that view, you might as well just lend them the money unsecured or the securities unsecured. But that might be a flippant answer. I don't know.
No, look, it's not, but I think it all needs to be put in context. So, look, Andy, we're running out of time. So, can I just ask you for your final thoughts?
Yeah, great. Okay, right. So, I guess that went pretty quickly. So, I'm hoping that people found that interesting and useful. I certainly did. Just to chat through those issues. I think as we conclude, a couple of things. Been a great series of events, and I think it's enabled the industry to get back into discussing the industry rather than, the pandemic. And we mustn't put the pandemic out of mind because that's been a horrendous thing that swept across the world, and many people on this call will know people who've obviously suffered badly from that. But having said that, it's really good that the industry is prepared to start re-engaging, talking about some very, very important issues. My sense is that as we end this little period and we go into the summer period, we don't know what's going to happen in the autumn. Are we going to get a second wave? I think if we were to get a second wave, we're all better prepared for that now. And as an industry, we did pretty well when we all went to work from home from about March 16th. And many of us are still doing that. So I think we're better equipped to continue to do what we need to do to support markets and infrastructure. Our markets did pretty well. The infrastructure stood up pretty well, but it also gave us that opportunity to think about, okay, so where do we need to focus future attention? And I think what I've seen over the last 10 days is that attention is clearly aligning around those 3 or 4 things we talked about, Roy, which is the digital agenda around standardization, the capital markets union across Europe. There's a bit of a Brexit thing going on there as well, but also the ESG agenda. I think those are the things that are going to drive a lot of what we do. And as you said right at the end, we've got this prudential agenda also that's out there. I do wonder, though, if some of those prudential agendas might have to be modified to ensure that Europe remains competitive. But I think the industry has done a fantastic job of getting to where we are today during a very difficult year. And I think we at the association, again, really welcome everyone's support. We will continue to do what we want to try and do in terms of taking the business agenda forward. And if anyone's got any further ideas and comments, where I and the rest of the team are. And Roy, I'd like to thank you for hosting this 1 hour.
And thank you very much again. A fascinating sort of range of topics, and there's lots to do still to take us forward. So, and congratulations to you and the ISLA team for all of the leadership over the last few years through a very difficult time, and this year's no different. So that's it. Thank you very much.